Assalamualaikum and hi, my name is Muhammad Irfan Imani bin Muhammad Zaidi and I'm presenting the topic Qualitative Characteristics of Financial Information. Let's start. First off, we have relevance. Relevance is important as relevant financial information is capable of making a difference in decisions made by users only if it has predictive value, confirmatory value, or both. Information on financial position and performance used to predict future, future position and performance and other things like wage rises and likely dividend. The relevance of the info is affected by its nature and materiality. Next is faithful representation. Faithful representation means financial information must represent relevant economic phenomena and also faithfully represent the substance of the phenomena. It must be neutral, complete, and free from error. Neutral means no bias in selection or presentation of information, while complete means that it includes all the info necessary for the user to understand. And finally, free from error. It means no error or omission of data or information. Substance over form is a concept which is a characteristic of faithful representation. Comparability. Comparability means that it enables users to identify and understand similarities and difference among items. If an item or entity can be compared to other entities, the info will be more valuable. Consistency is defined by the use of the same items with the same methods. The disclosure of accounting policies is needed to enable users to better distinguish the policies for a valid comparison between items. Comparability does not equal uniformity. Corresponding info for certain preceding periods should be shown to enable comparison over time. Next is verifiability. Verifiability helps assure users that information faithfully represents the economic phenomena it purports to represent. Because info that can be independently verified is better than info that cannot be verified. Right next to that is understandability. Understandability means presenting a concise and clear information by classifying it and characterizing it well. But in pursuit of understandability, one must not exclude the information on the complex economic phenomena because the financial report will be considered incomplete. Next is timeliness. Timeliness is shown by having info available to decision makers in time to influence their decision. There is a balance between timeliness and reliability. If it is too early, the info might not be complete or error-free. If it is too late, the info might not be able to influence decisions as it is irrelevant. Last but not least is consistency. Consistency is defined by the presentation and classification of items in financial statements should stay the same from one period to the next. An exception is made for the following examples: significant change in the nature of the operation or a review such as a more appropriate presentation, or when it is required by the IFRS to make a change in presentation. That's all from me. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. I'm Muhammad Mizal Zikri, and today I would like to talk about accounting concepts. Okay, it is materiality. Materiality assumes the significance that certain facts or data have in the decision making of a reasonable user, and how their inclusion or omission within the financial statements will have consequences in the evaluation of past, present, and future events. Based of the conceptual framework, information is material if omitting it or misstating it could influence decisions that the primary users of general purpose financial reports make on the basis of those reports which provide financial information about a specific reporting entity. Okay, for your information, an error which is too trivial to affect anyone's understanding of the accounts is referred to as immaterial. As Irfan said before, an error in the inventory valuations would be material. The assessment of an item as material or immaterial may affect its treatment in the accounts. For example, incorrect presentation may amount to material misstatement even there is no monetary error. Second point, substance over form. What is a substance over form actually? It is an accounting principle used to ensure that financial statements give a complete, relevant, and accurate picture of transactions and events. It is one of the characteristics of faithful representation. Examples of substance over form issue: the company hides debt liabilities in related entities so that the debt does not appear on its statements of financial position. Going concern. Based off the conceptual framework, going concern, the financial statements are normally prepared on the assumption that entity is a going concern and will continue in operation for the foreseeable future. This term also refers to a company's ability to make enough money to stay afloat or to avoid bankruptcy. If a business is not a going concern, it means it's gone bankrupt and its assets were liquidated. For example, many .coms are no longer going concern companies after the tech bust in the late 90s. Okay. The concept assumes that when preparing a normal set of accounts, the business will continue to operate in approximately the same manner for the foreseeable future, at least the next 12 months. Moreover, the main significance of the going concern concept is that the assets should not be valued at their backup value, the amount they would sell for it if business were broken up. Okay, for your information, if the going concern assumption is not followed, that fact must be disclosed together with the following information: the basis on which the financial statements have been prepared, and the reasons why the entity is not considered to be a going concern. Point. The business entity concept. The business entity concept states that the transactions associated with a business must be separately recorded and should never mix from those of its owners or other business. Financial statements always treat the business as a separate entity. The use of a separate accounting records for the organization completely exclude the assets and liabilities of any other entity or the owner. Without this concept, the records of multiple entities would be intermingled, making it quite difficult to discern the financial or taxable results of a single business. Okay, reasons for the business entity concept. First, each business entity is taxed separately. Moreover, it is needed to calculate the financial performance and financial position of an entity. And lastly, it is needed when an organization is liquidated to determine the amounts of payouts to the various owners. Accruals. Accrual basis is an accounting method where revenue or expenses are recorded in the accounting records and reported in the financial statements when a transaction occurs rather than when payment is received or made. According to the accruals assumption, in computing profit, revenue earned must be matched against the expenditure incurred in earning it. It is called matching convention. Accrual accounting is the opposite of cash accounting, which recognizes transaction only when there is an exchange of cash. Accrual accounting is almost always required for companies that carry inventory or make sales on credit. That is shows between accrual accounting and cash accounting. We go to the fair presentation. Financial statements are described as a showing a true and fair view when they are free from material misstatements and faithfully represent the financial performance and position of an entity. Under IAS 1, or we call International Accounting Standard 1, fair presentation requires the faithful representation of the effects of transactions, other events, and conditions in accordance with the definitions and recognition criteria for assets, liabilities, income, and expenses set out in the International Accounting Standard Board framework, or we call IASB framework. Consistency. Okay, the concept of consistency means that the accounting methods once adapted must be applied consistently in future. Also, same methods and techniques must be used for similar situation. Moreover, it implies that a business must refrain from changing its accounting policy unless on reasonable grounds. If for any valid reasons the accounting policy is changed, a business must disclose the nature of change, the reasons for the change, and its effect on the items of financial statements. In order to maintain consistency, the presentation and classification of items in the financial statements should stay the same from one period to the next, except as follows. First, there is a significant change in nature of the operations or a review of the financial statements indicates a more appropriate presentation. There is a change in a presentation that required by an IFRS. What is IFRS? Actually, it is International Financial Reporting Standard. And that's all from me. And that's all from us. Thanks for watching.
I don't belong.